All right, testing, 1, 2, 3. Is anybody out there? Let's see. We'll see if anybody can hear me, and then we'll move on to the singing part of the competition. See how the markets are doing, see what's up. What is up? What is that? Let's close that. Oh, no, we need that. We don't need that. Go away. Sound seems to be working, so we'll move on to the videos. Video engaged. See if that works, and then we'll be in great shape to get moving. La-di-da-di-da-di-da. Video is confirmed. We have webinar. All right, fantastic. Oh dear. I've been doing my portfolio updates. I haven't been looking. It's getting uglier and uglier, huh? All right, well, big deal. I mean, is that 267? Oh, my eyes. Oh, that's scary. I hate it when that happens. Getting worse. I'm gonna have to get some kind of reading glasses or something at some point. Anyway, looks like 2 something. I don't know why I always use this screen. I'm always at this distance. It just seems particularly small today. But anywho, so as you can see, all of the indexes are down. They are attempting to bounce at the moment. See, that's a nice support line for the NASDAQ. The Russell is also at support. These guys are below, they're below and below their supports there, so they're heading to this. And you know, if they can't recover this line, right? These are pivot points. If they can't recover these lines, then they're probably going to go all the way down to here to test this line, which is not good, especially if that's below 15,000 on the NASDAQ, and you don't want to break that line. That's really significant. Let's go take a look at the charts and see what they look like. Oh, what's the dollar doing? I was going to see if it's the dollar's fault. Yeah, well, I said that this morning, right? We knew we were going to bounce off 106, and we bounced all the way back to 106.60, and now we're pulling back. So you got to watch the dollar too, right? Because the dollar got rejected. That's what's giving the indexes a boost. Got nothing to do with the indexes doing anything correctly. What did Biden do? Biden did something I thought was pretty good, but I forgot what it was. But that was a big announcement today of something Biden did. And damn it, I was about to write on it, but then I realized it was webinar time. And now I forgot what he said or did or whatever it was. Let's see. Wall Street Journal. No, the Wall Street Journal is going to tell you Biden did something good. It's funny, the way news is now, you have to actually go to the right source to find a story because the other sources won't report it. It's really sick. Oh, here's the old Fed stuff. We don't need that. So let's go to WSJ.com. Look at all these tabs. It's crazy. Okay, somebody blew up a hospital. There's no question that a hospital has been blown up. The question is, what's going to happen to do it? So, bad news is that Biden. Something about aid. That was it. Biden was put his foot down and said aid must go into the Gaza to help people, and relief has to go in to help the people who are injured and sick and whatever. So, so he called off his meeting with the other Arab leaders. So we're like in this huge tense situation, and for whatever reason, Biden was going to have a meeting with the other surrounding Arab states, and he called it off. Who knows why? This is all Army intelligence crap that gets involved here. But that's not good. The speaker nonsense is still going on with Jordan. So we effectively have no government while this is going on. The House cannot do any real business without a speaker. And meanwhile, I don't know how many people remember your civics lessons, but see, Jim, this is about who is going to be third in line for the presidency. This is how Gerald Ford became president, because Nixon resigned and Agnew resigned, and that left Gerald Ford to become the president. He was the Speaker of the House. He came from a district in Michigan. I think in his whole life, maybe 60,000 people voted for him. You know, that because all he ever was the guy from this district in Michigan who was the Speaker of the House. And so the last election he had, and literally the last election he had, because after that he retired as president. He didn't retire, he was booted out of office, but he retired from politics. So the last election he ran, about 60,000 people voted for him, and suddenly he's president. It's kind of like that movie Designated Survivor. It's like, what the frick? We're electing the guy, or not us, but the House Republicans are electing the guy who is third in line for the presidency. I mean, it's freaking scary to me, especially when you look at the people they're putting up. Let's see. Dun, 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 dun. Oh, that's an interesting article. Anyway, 10-year treasuries keep climbing. China's in trouble. Country Garden is failing to make their payments, blah, blah, blah. I mean, come on. Of course we're falling. There's so many reasons that we should be falling right now. Anyway, so that's not the New York Times. So let's see what the New York Times has to say. And I know everybody thinks, not everybody, but I know a lot of people think it's a liberal paper or some bullshit like that. But honestly, if I want to know what's true, I read the New York Times. Yes, they have a liberal bias. I know that, but they won't. They go way out of their way to make sure they state facts. So anyway, so everybody's blaming, well, everybody, the U.S. and Israel blaming Palestinians. They say that it was a failed bomb shot at, a failed missile shot at Israel that hit the hospital in Gaza. And who the frick knows? You know, but these guys are, they don't have the knowledge and experience to fire these rockets, and they could do the trajectory wrong, and or there could be a misfire, or somebody didn't these things are on wheels, right? So somebody has to lock the wheels to create a stable platform, and if you don't lock the wheels, there's a huge kickback and it throws off the whole thing. So that's the kind of stuff they're talking about that could have easily caused somebody firing to shoot too low and hit a hospital like right in front of them. Who knows what's happening? But right now, the U.S. and Israeli intelligence say it was not a missile from their side. One thing we're getting pretty sure of, though, is these are Russian missiles that are being shot at Israel. Early, I mean, and then the thing is, though, who's going to believe it, right? Somebody else is going to have another report. So you never know what's going on. So Biden urged caution. Anyway, so the thing I heard was something about like Biden, like saying absolutely imperative that aid goes into the Gaza and Israel, and Israel has to allow it to go through. This is funny. It's Jeffries guy's a Democrat. He got more votes than Jordan. So, but still not enough. I think you need 207. I think you need 217. So if he can get 5 votes, I think we could have a Democratic Speaker of the House under a Republican Congress, because they can't agree on their own guy. He's got to somehow convince 5 of those people to flip. Let's see. Biden tightrope, blah, blah, blah. Harvard students are screwed, blah, 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 blah. Not much going on. Just just the normal noises. But meanwhile, the market is sliding away here. Let's see. Oh, much better bounce now. Where's my futures? Futures, here you go. Indexes. Daily. How about daily? All right. So, this is what weak bounces and strong bounces are, right? When you see this sort of stair-stepping pattern, it's like a slinky going down the stairs, right? This is not bullish, and the bounce is not bullish. You know, and look, here it is on our, here's the Euro stocks. This is a slinky. Okay. And when you see a slinky going downstairs and the little, you know, you know, it collapses and then it goes back up and then but then it folds over again, right? So when you see a slinky going downstairs, you don't sit there and go, there, it's going to turn around right there and start going up. No, it's never going to go up because of gravity. Right? It is always going to keep going down the stairs, even though it might look for a couple of seconds like it's going up, it's actually still going down. Those are bounces. They're what we call dead cat bounces in the market. This is a daily chart. This is quite a, you know, decent time frame. If we look at the weekly chart, we're still like, you know, we're way up here. We have been consolidating at pretty high levels for quite a long time, and we're starting to come back. And see, I mean, it's in Europe, it's in Japan, it's in Germany, which is in Europe. The Russell is drastically reduced. That's what, 15% on the Russell, right? So it's 15% on the Russell. We're nowhere near 15%. Well, let's do the math. Okay, so 15% on the Russell. 16,000. Whoa, where's my number to look? There it is. 16,000 times 0.85, 13.6. Okay, S&P 4,600 times 0.85, 39 something. These are ugly, right? So the Russell is, you know, that's why you get, you know, the Russell had a big move up, but look what happened, immediately collapsed. So, and then the Dow was what, 36,000, which is just like 3,600, wherever that was, times 0.85, wait, what'd I do? 36,000 times 0.85, 30,600. Holy shit. All right. So we're talking about some massive potential declines here just to catch up to the Russell. And this is no small trend for the Russell. This is what it's been doing. Boom, 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 boom. It's been falling very quickly. We went from the banking crisis in March, pretending everything is fine, and now we're back to, you know, basically a consumer pullback crisis, which is what we were talking about this morning. Well, we talked about it last week too, right? With the Fed minutes, the PPI and the Fed minutes and everything else. We've been getting these indications. Should not be shocking to us. Somebody needs to explain to me why nobody comments on the wrap-up, on the weekly wrap-up. My intention was I would have the weekly wrap-up written by the robots, and then people could ask questions of the robots, and I thought that would be cool. So in other words, you know, make Claude take ownership of his column, but nobody ever asked him a question. It's really frustrating for me because that's part of the experiment, was to see what would happen if people talk to him the way they talk to me in a chat room. It's like, hey, you wrote this article, I have a question about this, or what do you think about that? I want to see how he responds, but nobody asks questions. So if you have a chance, I would appreciate it if you would engage over the weekend with the, well, most likely Claude. We had one problem with Claude, but it was my fault. Last week, not this weekend that just went by, but the week before, we had a problem with Claude because I was doing too much with him earlier in the day, and so when we got to the part where he had to do the wrap up, it just completely overloaded his capacity, and he couldn't handle it. So then I had to give it to Warren. But generally, I'm trying to train Claude to consistently do the wrap up. Anywho, where are we? This was last week. No, this is today. Sorry. Brain. So we're waiting for the beige book coming out in 2 o'clock. We had the note auction. Let's see how that went. How did today's 20-year note auction go? I don't even ask Google. I'm so used to asking my AIs. Today's auction results. Non-competitive results. Competitive results. Oh, here you go. Nope. Upcoming auctions. What? Notes. That's weird. There's very much under the impression there was a 20-year auction today. The 8-week, the 4-week. Hang on. Oh, it was on the calendar. Bonds. Maybe it's because I said notes. If somebody wrote an article about it. Well received. So the auction went off well, but we expected that because of the hawkish Fed speakers beforehand. So in other words, let's find Microsoft and we go to chat. I think he knows I want him. Okay. I had a premise that the Fed speakers ahead of today's 20-year bond auction would be hawkish to drive traders into the bonds, as the Fed can't afford to have a bad auction, or it will look like they're losing control. How do you think my premise held up based on what actually happened? Really interesting, because it's a very complex question. Your premise is partially correct. How dare you? Some of the Fed speakers did express hawkish views ahead of the 20-year bond auction. For example, Waller, this is great though, right? I can get my whole thing answered in one shot. Waller said the Fed should start tapering its asset purchases in November and end them by mid-2023. He's got the wrong year. When Williams said that inflation is likely to remain elevated for some time, today is October 18th, 2023. So I'm not sure your analysis tracks with the date. Gotta be careful with Bing, because he'll freak out if you really criticize him. Now he's all confused. Nope, too complicated. See, this is why I still have to work. Thank you so much for trying, though. All right. Anyway, we're going to need him back for the beige book. Let's see. 20 euro. Okay, well received. So bottom line is the bond auction went off well. That was the point. had been a test of demand for long-dated government debt. Before the auction, the 30-year yields broke past 5%, while the 10-year traded at 4.9%. The 20 years went out. He didn't say much either, though. This guy, you can't get a good answer out of anybody. Humans are just terrible. Sign into Google. Oh, that's why I couldn't get my ChatGPT thing working. Oh, use another camera. Oh, see, Maddie screwed me up. Oh my God. See, she used my computer and messed me up completely. That's why all my stuff wasn't working. Oh no. Hope this is right. Ha ha! I know my password. Add or confirm your recovery email. Sign up to get useful tips. Not now. There we go. Now I feel better. That should make everything work better theoretically. Okay. Anyway, where are we? Yep. Oh, the big picture, right? We're looking at the bigger picture, futures. So, you know, it doesn't look so bad so far if you look at it. I mean, but this is a weekly view. I mean, the Russell looks horrific on a weekly view, and that's the thing you got to be concerned about, okay? Because obviously 20% off the Russell is 1,600, right? So therefore, you're dropping 400. You've got 80-point bounces, so they're almost 100-point bounces. But if you were looking at the bounces off of 1,600, it would be exactly 16.8 and 17.6. 1760. And so really you want to watch 1760. So now we take the Russell and we zoom in and we see how significant 1760 has been. Here's 1760. All right, and there's clearly a consolidation point here, clearly a support here, clearly a breakout over here. So it was a fail point. So 1760 is a very, very serious line that's being confirmed here. Now, the thing about that is if 1760 checks out, that means that we are seriously looking at the range of 2,000 to 1,600, and we haven't hit 1,600 yet. All right. If 1760 holds, but it isn't holding right now, but if 1760 holds, then you're holding at the strong bounce line, and that's kind of good. It means that you're probably going to be trying to work your way back up to 2,000. That's our next goal. That would be, so in other words, if I was doing a range, this was, we've already broken up over this range, and we'd be using right now probably a 20% range above 1,600. So let's say frick. 1,600 times 1.2, so 1920 is practically 2,000 anyway. So we'd be looking at a range from 1920 would be the top of our range, and then we'd pick a midpoint. So that would be so this would be the top of our expected range. Would be 20% above, and 10% above is obviously going to be 1760. Which is right where we are. So it checks out every which way it checks out. Because, you know, and I you know, without getting into it, going back to the beginning of time, in other words, for the Russell, it goes 400, 800, 1,600, and the next move would be, well, I mean, it'd be halfway between 16 and 32, so it's about 2,400. So the really super bullish next range of the Russell would be 24. We're nowhere near that. That's not even considered at the moment. But even if you say 2,400, then you'd be at 2,000 plus 20%, and 2,000 minus 20% is 1,600. So at every sort of level you check, whether you check annual, if this was a yearly chart, if this was a monthly chart, a quarterly chart, it keeps coming up that our significant spot is going to be 1760. That is just consistently coming in as a range to watch for the Russell. It is 10% over 1600. And as we said, 20% over is 1920. And so, you know, and you can see this, we don't really sustain a move over 1920 for very long. In fact, there's not even a month really where that happens. Okay, well here, this is, call that a month, but basically really not for more than a month do we sustain a move like that. And that's a very strong indication that this is the top. And you can see that because you go to 1920 and look what happens. Look at that. Look at these. It's hard for me. What am I I'm pointing my finger? It makes no sense. Because if I do this, it moves. You know what I mean? So, but here you go. I mean, you're 1920, 1920, 1920 there, right? So 1920, 1920, 1920, 1920. It just keeps coming up. And if it keeps coming up like that, it tells us that the 5% rule is absolutely applied here, as it should be on large indexes. But if that's the case, then logically you have to say, okay, well then it's trading as if it's in a range between 1600 and 1920. That's the range we're trading in, 20% over 1600. At the moment, we're exactly 10% over 1700, which is 1760, exactly 10%. So the middle of our range is really where we are now, 1760. And we have been trending to the upper part of the range. But if things get worse and we start going down, then we're going to see probably consolidation on the way back to 1600. And if that's happening, you can be damn sure the other indexes are going to fall 10%. They are, you know, the Russell's not, you know, oh, we used to talk about this. Wow, things seem ancient when you talk about them. I used to talk about thinking about the index as like a tugboat. So in other words, you know, I'm sorry, the indexes act as a tugboat with each other. So in other words, when one of the tugboats is pulling here, there's a certain midpoint to the indexes, right? And so these guys are all trying to hold the line and keep it up here. But this one tugboat is going off to the side, right? So you have three tugboats that are pulling the barge along at that level, which you can see it's all basically the same level for them on a long-term chart. But then one tugboat starts heading off in the other direction. So there's only two real things that are going to happen. Is one is that the tugboat, the Russell tugboat that's off on the side, is going to get snapped back to follow the others, because it can't by itself, it's not going to be able to alter the overall course of the markets, right? Of the market ship. It's not going to be able to by itself alter the market ship. On the other hand, and by the way, some tugboats are bigger than others. Like the Dow is an insignificant thing. The Russell is small caps, not very weighty, but the S&P and the NASDAQ are very large tugboats, so they matter more than the others. But you have to imagine there's some invisible string, and that would be 20%, right? That, or really it's 10%. The indexes aren't going to get much more than 10% away from each other. Any index can go 20% up or down, you know, with, you know, in a normal range, they can go 20% up or down over a year, let's say, or a couple of years. That's normal. But the individual tugboats are not going to get that. That only works if all of the boats line up together. But in this case, the Russell is being the one that has stretched its line to the limit. So either the Russell snaps back and comes back in line with the others, or the others begin to follow the Russell and the whole boat starts turning south. And the boat would be the entire stock market starts turning south. And then you have tremendous momentum pulling everybody down. All right, so I used to do this with pictures. It's you gotta just think about the model, and the reasoning is, but then it's up to us to now look at each individual tugboat like the Russell and say, okay, so it's obviously stretched here. 1750 should be support if the other indexes. So if NASDAQ 15,000 holds And if S&P 4400 holds, then there's no, and Dow 34,000 holds, then I don't see the Russell going lower, which means maybe I can make a bullish bet on the Russell. But if the Russell fails 1750 and the other guys, and even one of the other guys starts failing their line, I have to seriously question the entire concept of support. And here we have the S&P already failing 4,400. And these are futures because the actual index is quite a bit lower than that anyway. Because there's still more optimism than there probably should be as to where we're going to end the year. So then you have to examine each index. Now with the NASDAQ, it's easy because there's only 10 stocks that matter on the NASDAQ. The S&P, there's 20 stocks that matter on the S&P, and the Russell doesn't matter. You just want to kind of look at the overall, there's no real stock that's more than 2% of the entire Russell. There's like lots and lots of stocks on the Russell that are, I mean, maybe not even 2%, maybe 1 point something. But there's no major stocks that move the Russell up and down by themselves. That's very important on the Russell. But that's why it's a good indicator. It's like the NYSE. Oh, and we were watching the NYSE. It's probably here. Or is it the NASDAQ? That's the NASDAQ. I have to go to, what is this? This is stock charts. Oh, there it goes. I couldn't see the top of the thing. So I want to go back to my main screen, see if I can find the NYSE chart that I made. Fortunately, I don't need too many NYSE charts. I never saved it? Oh, really? I thought I saved that one. January 2020. Good as that. Oh, that's the closest. All right, 22. So as we've been saying for a bit, 15,000 is a critical hold on the NYSE, but the problem is the 50-day already went to 15,050. So that means that the Russell is now below, not the Russell, sorry, the NYSE, which is every stock basically. So now the NYSE is below the 50-day moving average, and that is trouble with a capital T that rhymes with pool or whatever the hell the thing is. So, we're miles above the 200-day moving average. It really wouldn't be a stretch to imagine that this thing falls, and 14,000 is not even 10%. So, we could easily run into trouble here. And I guess if we go to, let's say, NDX, also, see, I mean, you're getting confirmations here. These are daily charts. You're getting confirmations here. The NASDAQ failed its 50-day moving average and at 15,000. So that's bad. And then you've got the Dow, DJIA. Oh, come on, DJI. DJX? Can you give me that one? No, I want the real Dow. DJI. No. This is frustrating. And DJI, it doesn't work. I don't understand this. Show me all symbols. No, show me all. Dow Jones. INDU? Are you kidding? DJA, Dow Jones Composite. No, Dow Jones Industrial, INDU. That is not what it used to be. I'm not crazy. Okay, there it is. But oh, now see, below the 200-day moving average here. This is trouble, guys, with a capital T that rhymes with a. Here, wait. Let's see. Trouble in River City. Yeah, this. There you go. That kind of trouble. Can you guys see the video when it does this? Or is it like, I'd be very impressed if it can transfer video. Anyway, you get the idea. You can go watch the play later. How are we doing? Anybody get questions? I'd like an answer to that one though, please. I really am curious if you can actually see the video, do the video. Because if you can't, I'm going to use it more often. All right. Trouble, right? Yes, trouble in River City. That's where we are. So this is bad. These are bad signals. And again, we were showing the map. You have a death cross coming. We're at and here's how you know when this is the thing you watch, and it's not about, obviously it changes every day, but the thing is it getting better every day or is it getting worse every day? This is bad. It was getting better, but the problem is you got 34. So 3, 4, 2, 5, 8 minus the current position of the Dow, 33756, is 502. This is the 50-day moving average. So divided by 50, obviously, is going to be 10. This is dropping 10 points per day. If so in other words, Dow here, this goes 10 points lower. That's the moving average. That's how this whole thing is calculated. So I know if the Dow stays below the 200-day moving average, this is going to drop at least 10 points per day. And we only have 3, 4, 2, 5, 8 minus, well, it's going to be the same number, right? It's going to be 50 days minus the current amount, which is 33756, 33756. This happens to just work out to be exactly at 10 points per day. We have 50 days, 2 months before we cross under. So if the Dow is under the 200-day moving average, you got to think about how the charts are created. Think about the math that goes into creating a chart. What TA people do is they take a look at the picture of where the Dow has been and they try to predict where it's going. Whereas we don't do that. We understand the math of the chart. So if we're below the 200-day moving average, then the 200-day moving average is what? It's not going to be rising, is it? Therefore, the 200-day moving average is at 33829. So at 33829, if we're under that, then we're drawing the Dow down at 10 points per day on the moving average, and it will take 50 days for it to hit the 200-day moving average. So that's really the thing you take into the next session is we're falling at a 50-day rate. We were falling at a 30-day rate earlier in the month. If we had stayed down there, we would have hit this death cross in November. That blue line would be coming down very sharply. But we didn't. We popped back up and we slowed the descent of the 50-day moving average. But the reality is, when we'll, it's like 2 trains, right? It's like 2 trains leave the station, blah, blah, blah. It's like if the 200-day moving average is not being affected by the Dow, and the Dow would have to be significantly higher than the 200-day moving average before it starts moving, because it takes 200 days for it to average in. So if the Dow is in between here and here, you're still going to be seeing the 50-day pulling lower while the 200 stays flat. The Dow would have to be up here to really start moving the 200-day up. So the 200 days basically flatlining, or worse if the Dow is lower, and the 50 days dropping at 10 points per day. So it's going to close the gap in 50 days. Now, like I said at the beginning of the month, we were talking about the NYSE, but like I said at the beginning of the month, it was a matter of saying where are we now and how fast are we falling and when are we going to get there? So rather than being a TA person who looks at a chart and just makes up bullshit, we got math. I know what's going to happen. I know what will happen if it stays in this range. And then what we do is we do a valuation analysis of the Dow, of course, is bullshit, but of the S&P or whatever. We do a valuation analysis. We decide whether or not these stocks are too expensive or not. We're going to have a damn good idea of that over the next month, over the next 2-3 weeks, actually, for the S&P. We should be done with them. And we'll be able to do a valuation analysis that says, okay, at this point, we know where these companies are going to finish the year. We've got 3 quarters under our belt, and they told us what they're going to do next quarter, and we're halfway through next quarter. We're not halfway, a third of the way through next quarter. So there's only November and December left. There's not likely to be some shocking change in what happens. You've only got 2 months out of 10 left to put on the books. The companies are telling you their guidance. They're telling you where they expect to finish the year. We got a pretty damn good idea of how the year is. Then we have to look and say, well, is this worth it then? This is what this year looks like. Is it worth it? And once we do that, we know whether or not we should be above or below the 200-day moving average. And if the earnings of these components show us that they should be below the 200-day moving average, that they've actually deteriorated from last year, that there's no reason for this stock right now to be higher than it was 200 days ago. All right, and it's 200 trading days, it's not 200 days. So 200 days is basically the 1-year moving average. So did these stocks that are driving this index perform in such a way that they should be valued higher than they were 12 months ago? Very simple question, right? We have enough data coming up in the next couple of weeks to do year-over-year analyses of the stocks. That will then tell us whether or not the market is overpriced or underpriced, all right, or fairly valued. It's basically as we all know, though, it's pretty much overpriced. $2.5 trillion of the gains that we have in the market are entirely from AI speculation, from Nvidia's market cap, which is obviously all AI, from the Microsoft, the amount that's contributable to Amazon or Bing or anybody else from Microsoft, whoever has attributable AI benefits that have driven the market higher. Of all these stocks, $2.5 trillion is what's been calculated, and I trusted the sources when I read it. I don't remember where they were. And that's like 10% of the market is all based on AI speculation, which is very much like .com speculation. In 1999, 1998, 1999, nobody was wrong that the internet was going to be gigantic. Nobody was wrong that internet companies would come to dominate the world. And nobody was wrong that this was the next major step in our technological evolution. But they were wrong about 90% of the companies they put their money into. Because just because something is the next big thing doesn't mean everybody's going to make money because they touched it. And that's the problem with investing. That's the problem with investors, is they just believe that if it says AI, it's going to be investable. I've pointed out on many occasions in this year that there are only about 11 out of 500 companies on the S&P 500 who are providers of AI. And that would include Amazon with their cloud services, Microsoft with their direct investment in OpenAI, ChatGPT, and their Bing product and their cloud services. So Microsoft's like, triple bagging their benefits from doing this. They provide cloud services. They invest in the company that owns the AI. They've got the search engine that used to be a non-competitor and is now becoming one of the best AIs out there is Bing right now. So they've done many things that I would not bet against Microsoft. So when I'm evaluating the S&P and you tell me Microsoft is a great value, I'm not going to argue with that, of course. In fact, Stockopedia, blah blah blah. I always get sidetracked checking facts. But that's what I do when I'm writing, when I'm researching anyways. This is what happens to me. It's like I have to know for sure. It's like I say something and then I'm like, is that really true? Let's take a look. Okay, it's excuse me, 2.5 trillion frickin' dollars. So they've actually hit a level where they're no longer a super value. They really are not. I mean, that's they're Apple now, but they're not Apple. They don't make as much money as Apple. So it's 28 times earnings. It should, come on, any stock should be 20x. Look, they're a phenomenal company. I mean, 168, 198, not even down. Well, they benefited in 2020 because more people were stuck at home playing with their computers. So they never got hit by COVID. Nothing, no damage to them whatsoever. Profits are up, and you're talking about profit growth, 11 billion here and 9 billion here and 12 billion here is their profit growth. That's freaking amazing. So, oh, I'm sorry, not 20. This is I thought I was telling that was TTM. So they had a pause this year, but next year they expect to go back to it. And why do they have a pause? Well, they just spent $10 billion on OpenAI. I'm going to give them a pass on that. They wrote a check for $10 billion to OpenAI. It came out of their earnings. So was it a good investment? Oh yeah, that sets them up for the 95. That's why they're going to get to 93 because they spent the 10 here. All right, so money well spent. People, they invested. But meanwhile, what's the reality? The reality is they're at freaking $2.4 trillion and they're not making even, they're not even making 100. It's so silly to say. They're not even making 100. They still can't say it. All right, hang on. I'm gonna get this sentence out. The problem with Microsoft is they're still I can't do it. They're still not making $100 billion. There, that's end of series, right? Okay. That is so ridiculous. That is the most ridiculous statement that could possibly be uttered. And literally, if you went back 10 years and somebody said that statement, it would be completely and utterly just reviled by the investor community. Everybody who heard that would think you're a moron. It would make no sense to anybody. And now we literally, I mean, look at Microsoft. 2018, $16 billion. Now $93 billion a year. 93 billion, from 16 billion to $93 billion. That is kooky. Where were they then? What year is this? 2018. Here you go. 2018, they were at 109. So they had a huge PE ratio back then, right? They were at 109 and they were making 16. So that means they were $800 billion making $16 billion. So we go 800, right? Because we take 2.4 divided by 3, they were at 1/3 the price. So they were at $800 billion in valuation, which was almost $1 trillion. It was still a lot of money. Divide that by 16, and they were trading at 50 times earnings in 2018. Over here. So now they've tripled and they're only trading at 30 times earnings. So, phenomenal. And they deserve it. They look at all the freaking money. It's almost $100 billion, which, that would be impressive, but this is not. No, still can't do it. Okay, anyway. So, like I said, I would look at Microsoft. I would not say this is why the S&P is going to crash, or the NASDAQ is going to crash. But seriously, you can't sustain 30 times earnings for a $2.4 trillion company. You can't. The return on investment of owning Microsoft is 3%. You're only getting 3% on your money by investing in Microsoft. That's not good. I need more than 3%, especially with inflation. And the owners of Microsoft are not you know, it's not day-to-day investors. The owners are institutions, and those institutions have to make enough money to pay their investors. And you may think this is $100 billion, blah, blah, blah. Yeah, but it's owned by X amount of people, blah, blah, blah. It's spread out among this. It only ends up to, well, it's EPS. It only ends up being $12 per $332 share. So wait, let's make sure we get the right amount. And this is what, by the way, this is what valuation is all about, okay? So not even this year, not even right now, but the future value, supposedly, if all goes well, is 1260, all right? So it's 12.6 divided by, what do they get? What are they getting for this thing now? By 332, well, 333, let's say. It's divided by 333. You're getting 3.7% back on your money. But if you would have just bought today a 10-year note, you'd be getting 5% back on your money. And the 10-year note won't crash. Well, it will relatively crash, but it won't. The 10-year note won't crash if we go into a recession. In fact, it'll probably increase in value if we go into a recession. So your 10-year note is 5%. Microsoft is 3.7%. That's a big freaking difference. You want to know how much of a difference that is? Let's go to one of my other favorite things. Compound interest calculator. Wow, Google is so smart. Why is Google so smart, but Bard is so bad? I heard they improved it though. I really have to try it again. So what did we say? 1.5%? So 1.5%. Let's say you put $100,000 in and you don't add anything to it, and 10 years from now, yeah, that's the amount, $16,000. So out of $100,000, if you put your money into Microsoft instead of a 10-year note, aside from assuming the risks of the market, you are going to get 16% less money back on the Microsoft than you would on a 10-year note. Now, maybe Microsoft will have another big growth spurt and punch up and blah, 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 and who knows. But the reality is that's not how institutions think. They think, where am I going to get the best return for my money? And God forbid, you know, if notes start going up to 6%, 7%, and Microsoft's returning 3.5%, which is half, then institutional money is going to start going into notes, which is what the Fed wants also. You have to be careful about that, because the Fed wants money not to be in speculation. They want it to be investing in bonds, mostly because the Fed needs to sell the bonds with the government. So they don't want the bond market to collapse. They really don't care if the stock market collapses. They care about the bond market. Oh, almost beige book time. All right, so back to charts before we got so distracted. That chart. Nope. What the hell were we looking at? Oh, we were looking at that, right? We were talking about it. So, I'm sorry. Now I remember where we were. So, you look at the components one by one, just like we did with Microsoft. And I would say Microsoft should be lower, and that's a drag. Apple, probably about the right price for Apple. You know, and again, I can't stop myself. It's like a ADD thing, I think. But Apple's multiple, see, Apple's 2.7 trillion, 27 times earnings. See a theme here? You know, you can't keep doing this, especially when the alternative bonds are so much higher. You're not going to attract more institutional money. And the other problem is when that happens, if you don't have money coming in from institutions, any kind of panic selling, you won't find any buyers. So if anything panics the retailers out of these stocks, they think they can drop like a rock because they can't find any buyers. There's no institutional money waiting to get in. Where does the institutional money come in? It comes in when you're returning 5%, and that would be a 20 times valuation is 5%. That's reasonable. That's in line with the bonds. That's where this all comes from. Are stocks more attractive than bonds? Well, what does a stock pay? What does a bond pay? A bond pays 5% now. Then a stock needs to pay 5%, or it has to have better prospects. You have to have a bullish outlook. You have to think everything is going to be okay, that there are not going to be any obstacles, because obstacles, of course, make the bonds more valuable. So obstacles really can't be in the way. Everything has to be smooth sailing, going forward, great growth, global harmony, blah, blah, blah. If you don't have that, bonds. And you know that. You guys learned this in Econ 101. It's like basically you allocate money, stocks or bonds, right? And it goes more towards bonds. When you're younger, more stocks. When you're older, more bonds, because you need the safe rate of return. That's all been, and this is all part of the whole problem of, like I said, we haven't had any actual inflation in 40 years. 40 years there hasn't been inflation. So people who are younger than 60 don't even understand the concept of what's happening. They read about it, but they don't get it. All right? You can't afford to live on the money you have if you're not keeping up with inflation. And that goes, and the people who are retired or retiring, people over 50, they're very much watching that, and this is how you end up getting recession, because they're all looking at this thing and they're saying, well, I have $500,000, but my expenses currently are $50,000 a year. So I'm not going to have 10% a year of income coming in. I'm only going to have 5% of a year of income coming in. I'm let's say retiring right now, $500,000. I'm 65 years old now. I currently spend $50,000 a year on my expenses. I'm retiring. I won't have any more income coming in. I have Social Security. Maybe that's a couple of thousand a month, right? And that's great, because that means you only need $30,000 drawn out of your retirement. But still, the problem is you're not going to get $30,000 at 5%. You're going to get 25. That means every year you have 5% less money coming out of you have 5% less money than you need, and therefore you will be depleting your cash. And if you're going to live for 20 more years, and people, and they kind of plan on it at this point, they plan on being 80, at least 85. I mean, and it's the worst when you don't plan on it, because then you're 85 years old and you ran out of money. What do you do? But you're going to be 80 years old, so in 20 years at $5,000 a year, you're going to be depleting your reserves by $100,000, and that means that over that time you'll then be only getting at 5%. You only get $20,000, and it won't supplement. But then also, if I know down here in Florida, like, basically they're raising rents like 10-20% at a shot, and that blows everybody's retirements out of the water. Now it's like you can't possibly keep up. Nobody can keep up with that kind of thing. So what happens? You have to cut back on this. You have to cut back on that. People don't spend money. This is a recession. And Social Security never keeps up with inflation, so that's a disaster also. And this is a situation we're stuck in right now, and it's not going to resolve itself overnight. It's not going to go away next year. It's not going to go away the year after that. And the government has less and less money because they're more and more in debt, and they have to pay more and more money in interest so they don't default, because if they default, the entire planet will explode. So we got that going for us too. Anyway, so bit by bit, you have to evaluate these companies, but at least Apple's earning $100 billion, right? I mean, that's not a bullshit company like Microsoft. So, you got two companies with a 2.5 trillion plus valuation, Apple and Microsoft, and they weren't there last year. Where'd this year start? I think it started in January. Here we go. Where is it? So last year, Apple was 120, now it's 180. So it's up 50%. 50%. So 1/3 of two. So they've gained $1 trillion this year, right? So this is how you can see how techs have gained. And Apple's not even really an AI company. That's the funny thing. They should be. I don't understand why they're so slow on it, because they've already got Siri. It's kind of an AI. Microsoft last year, January, was 229. Now it's 3 something. So also 50% gain. So another 800 billion there. There's $1.6 trillion. It's added from 2 companies for the NASDAQ. So 5% of the NASDAQ's total gains have come from 2 companies. So then you say, do they deserve to be that high? Both of them could use a bit of a haircut. Both of them could easily drop 10% and still not be cheap. So this is where you start running into trouble, right? You've got these huge companies who are priced way above what a safe 10-year bond return would be, and we're heading into choppy waters in the market. This is a recipe for a really good pullback, like 10 to 20% of a pullback, which is the same thing we've been forecasting forever. Because again, like I said, this isn't like some sudden change. This is something we've been seeing coming for a long time. The question is, when exactly will it happen? When will things really fall apart? And that just really kind of depends on what kind of catalyst we get. But the market has been way more resilient than you would think. But you know what? This is exactly what we said back in 2007 when we were the subscribers at the time were they were sick and tired of me putting up this Bill Murray thing that said it just doesn't matter. Oh, let's do that. Testing the video. Has anyone said the video works? Oh, yes. Thanks, Corey. Corey said he saw the video. So it just doesn't matter. Although it's time for the Fed, so we'll do that. But this is Bill Murray. Here. Oh, for God's sake. There you go. There you go. That's one of my favorite clips. So, point being, in 2007, it was the same thing. It was like, why aren't we crashing? What is going on? How is it possible we are not collapsing? And it was, banks were falling apart in Europe, banks were falling apart in Asia, the housing market was starting to fall apart, the commercial real estate market in this country was starting to fall apart, and yet the market went up and up and up, or it didn't go up, but it kind of like, it was still floating along as if it just didn't matter, as if nothing that actually happened mattered, until suddenly, in the summer of 2008, everything mattered. And you couldn't catch a break. No matter what happened, the market would go down and down and down and down and down. And it relentlessly went down, like about 60% down in the end. Which was obviously way oversold. That was ridiculous too, but that was fine with us because we played that one really well too at the time. But we were fortunate because despite losing money constantly on our hedges to the point of real annoyance, where it was frustrating that we would keep hedging, and because the market wasn't going up, so we weren't making that much in our portfolios, right? We make money because we sell a lot of short calls. So, but we weren't doing tremendous in our portfolios in 2007, but we were getting killed. Like most of our profits were going into the hedges, because we kept putting money in the hedges, and everybody was tired of it, and people wanted to get more bullish and so on and so forth. And I was just like, it's going to collapse, it's going to collapse, it's going to collapse. But I sounded like, Chicken Little. Until finally I became a genius, because it did collapse, and I called it. So it's all about timing. That's why I'm much more restrained these days. It's like, it will collapse. I'm telling you now, it will collapse. I don't know when. So we enjoy the ride while we can. So where are we now? Fed, beige book, right? Beige book. See, all right, let me get back to that later. Google that, what I just did there, it's Google is phenomenal. Why can't they turn that, whatever they're doing there, turn that to Bard and say, hey, when someone says this, we look up this. When someone says that, we look up that. When someone says this, we look up that. That would make him really smart. All he has to do is read the freaking links that he's going to, that are being suggested here. So I don't know why, you know, and again, I haven't tried Bard in a few months, but I mean, it was really such a disappointment. I couldn't even bother with it. It was just ridiculous. And I'm good at this. I'm very good at picking the winners because I picked Claude at the time. I was like, oh, Claude's way better than Bard. I'm going to start using Claude. And lo and behold, Claude suddenly got super popular and backed by Amazon and everything else. So where are we? It's October 18th. We're going to open up the HTML. Let's see. Control C. Here, where's our buddies? Here's this Claude. Oh, he recognizes me now. How good. See, remember last week he didn't recognize me. So I fixed that was because of my daughter, Madeline. What is this? This is a lot of stuff. I gotta know what conversation this is. We talked about the Fed. Okay, great. Except I don't know if this instance of him is going to be able to read this. The beige book just came out for October 18th, 2023. Can you summarize and analyze for us? This version of ChatGPT of Claude may not. Oh no, he can't at all. What am I being an idiot? I'm sorry, Claude. No, he can't. Claude can't do this at all. It's Warren that can do. It's ChatGPT that can do this. Can't load that conversation. That's interesting. Okay, so what did I say, Claude? All right, so I'm going to say this to Warren now. He has plugins, so he should be able to do this. Here's the beige book. Control. Could not parse. Oh, frick. There you go. Nope, because now he's on GPT-3. GPT-4. Shit. Plugins, beta. Yes, plugins. No plugins enabled. This search, and he likes Wolfram. I don't know. He always asks me to give him that. He has fun calculating things. There we go. So he should be using his web search ability here. Yep, see, mixer box search. That's the best. That's the best one so far that we've tested. Even the browser Bing doesn't work either. Oh, come on. You kidding me? Okay, so that doesn't work. Could have read it by now. No, we couldn't. Your browser has been updated to the latest version. What is going on here? Why is everybody doing this to me? Yeah. Next. Free classes. Wow, look at that. Yes, start browsing. Except I don't want to really browse. I want to chat. Let's see if now see he's based on the same search engine. So Microsoft just does something better. Sure, I can summarize and analyze the beige book for you. But is he really going to do it though? That's the thing. You never know if he's just bullshitting. He's telling me about the beige book. That's not helping. Oh, no, here you go. And covers period from August to October. Here are the main findings. All right, great. So he's on that. But then the best way to do it is to just Control A, Control C, and then go to Claude and say, oh, it pasted this table. Look at that huge text file, 108. So then I say that, and now he's going to give it a shot. And we'll see who does a better job. So Bing is telling us economic activity increased at a moderate pace. Some districts showed slowing and leveling off due to supply chain, blah, blah, blahs. Consumer spending was mixed. Some districts reported strong demand in leisure and hospitality. Others noted declines in retail sales. Many districts cited supply constraints and higher prices. Manufacturing activity continued to expand in most districts. It's too fast. It's faster than I can read. Some districts for the manufacturers raising prices and passing on costs to consumers. See, now the difference is, notice, Claude does not have internet access. He is only going to report based on this, which is nice. He's also much smarter than any of the other search engines. But that's because I trained him, though. It's not just because he's inherently smart. Manufacturing activity continues to expand. See, labor, when you read this, labor challenges is, that's going to be inflation, right? Now I start thinking he's making it up because he's talking about how some districts noted the Delta variant of COVID had a negative impact on some service sectors. I don't know that I believe that. So let's see if they even mention COVID. Control F. All right, let's see, Delta. Let's see. Nope, no mention of Delta. 2 mentions of COVID. Oh, well, somebody did say that. Concerned that customers would rein in their budgets. Another said that this manufacturing, more than 1/5 of the firms expect COVID-19 to be a constraint on capacity utilization. Interesting. Okay, I'm going to give them that. Where are you? Residential real estate was varied, blah, blah, blah. Residential construction, material shortages, higher cost labor, commercial real estate activity improved. In most districts, that's good. Well, increased demand for industrial warehouse space. However, some districts reported office vacancy rates are high. Some tenants seeing shorter leases and more flexible terms. Commercial construction activity faced supply chain disruptions. Material agricultural conditions were mixed. Employment increased in most districts, but at a slower pace. That's good for the Fed. Many districts reported labor demand exceeded supply. That's bad, resulting in labor shortages. That's a big theme. Price pressures intensified in most districts. Input costs rose faster than output prices. So we're talking about margin compression. Many districts reported that businesses faced higher costs for materials, transportation, energy, blah, blah, blah. The summary, the Beige Book suggests the U.S. economy continued to grow at a moderate pace in the late summer and early fall of 2023, but faced headwinds. The next meeting's 1-2. Well, it does seem like he knows what he's talking about. All right. Oh, that's them. And let's see what Claude says. This is it. This is a real short summary. Here's the summary analysis of key points for October. Activity was little changed in most districts in September. Consumer spending mixed. Tourism improved with some slowing in travel. Bank lending declined slightly to modestly. Credit quality stable, healthy, but delinquencies rising slightly. Real estate little change. Inventory is too low. It's still low. Manufacturing output increased, growth expected to be stable. Weaker labor markets. Labor market tightness continued to ease restrictions. Employment is up slightly to moderately. Hiring is less urgent. Candidate pools expanded. Still challenging hiring skilled trades. Older workers staying in the labor force. Wage growth remains modest to moderate. Less pushback from the candidates on offers. Firms modifying compensation. Prices continue rising at a modest pace. Overall input costs stabilizing for manufacturing, but still rising for services. Sales price increases slower than input prices as consumers made price sense, Sales price increases slower than input prices as consumers more price sensitive. That is grammatically incorrect. Firms struggling to maintain margins expect slower but ongoing price increases. Next. Interesting. Another one. Next few quarters. Activity and labor market resilient, but signs of moderation emerging. Boy, he's really getting a little weird there. Inflation pressures persist, but some tend of easing. Rising risk still skewed for inflation over slowdown now. Support case for further measuring tightening. Support case for further measured tightening. So activity and labor market resilient, but signs of moderation. Inflation pressures persist. Risk skewed to inflation over slowdown. Supports case for measured tightening. The Beige Book shows the intended slowdown taking hold. Though inflation remains a challenge, the Fed will likely continue deliberate rate hikes, but risk appear more balanced. Okay. Please make the case for or against rate hikes at the upcoming November 1 meeting of the Fed using all available data. See, and it's a shame because Warren is our best analyst, but he can't see it. I don't know why. Maybe, I wonder if that's going to help. What if we look at the PDF version instead? That's interesting. I don't know if you can read PDFs. Can you read this one? Damn it. You can download the PDF and upload it here. I can then read the rest of the text. Okay, well, I'm not going to do that right now. Okay. How about trying the HTM link again? I know for a fact it's available. Nope. Don't know why that is. It's really annoying. So back to this. Let's go back to the HTM ourselves. Let's give one more shot though. Let's see. Okay, this report. You see, the problem is I mean, I guess we can not do the regional banks. Oops. In the 5th district, we don't want to hear about 5th district. Prices, manufacturing, real estate, banking. Whoop. No, that says 3rd district. Oh, these are still districts. There you go, San Francisco. Whoa. All right, highlights. Let's give them the highlights. But I'm not going to give them the details because it won't fit. I'm not sure this will fit, but we'll see. Okay, let's try a straight data dump. Quote, end quote, Is he going to kick out? No, he got it. Wow, very good. Okay. So you never know where he's going to cut off. So who else what did we do there? Claude was me. Oh, good job, Claude. Look at that. Here's the assessment of the case for and against the hikes of the upcoming meeting. Case for a red hike. Inflation is still high at 8.2% in September. Core CPI was elevated at 6.6%. Labor market remains tight and low. Unemployment 3.5. Consumer spending indicates economic resilience. Survey market, blah, blah, blah. Raising rates, territory, further tightening would enforce the Fed. Risk of over tightening appear manageable. Inflation shows signs of having peaked and starting to moderate. Wage growth, services, housing, inventory, tighter financial conditions, further hike, large risks. Both sides have reasonable arguments. Risk more balanced to a 20 to 50% hike. Allows a compromise. Further tightening key is strong. Okay, not that helpful, really. Now let's see. Don't let me down, Warren. Whoa, what do you do? Oh, he's done already. Holy shit. Okay, so Warren says, the beige book prepared by the Fed indicates that most districts experienced little or no change in activity. Consumer spending was mixed. There was a slight modest decline in loan demand. The real estate market remained stagnant. Manufacturing had mixed but generally improving outlook. The near-term outlook is described as stable or weaker. Labor market's tightness has eased nationwide while employment has increased slightly to moderately. The urgency in hiring has reduced. Wage growth remained modest, and firms are modifying their compensation packages to mitigate higher labor costs. So they're paying more but giving less benefits. Prices continue to rise at a modest pace. Input costs have stabilized. Firms are struggling to maintain profit margins as they can't fully pass on cost pressures to consumers. Well, that's not good. But this is what we're worried about, right? This is why you're seeing the Russell, the small caps are going to fall apart first because they directly get hit by something like this. The large caps, you know, they've got better modeling, they've got better pricing power, and so on and so forth. They've got their giant advertising budgets, and also they have their accountants to shift the books around so it doesn't look like they're getting hit as hard. It's not necessarily good. It just means that you're not seeing it yet. Boston, slight expansion, pessimism in real estate. New York, modestly weakening activity, solid labor market. Solid labor market is obviously tight. You know, New York, here's the thing, when you ask New Yorkers, because you got to realize this also, when you're asking liberals, you know, a generally liberal state, how's the economy? They're like, great, everybody's got jobs. You know, it's like, that's not necessarily good for the market. Philadelphia, decline in business activity, modest wage growth, inflation. Cleveland, little change, concerns over impact of the strikes. Richmond, slight contraction, limited inventory. I don't see anybody saying, you know, great things. Atlanta, slow growth, decline in domestic leisure travel. Chicago, modest activity, slight increase. Chicago's improving a little bit. St. Louis, unchanged conditions, difficulty in passing on input costs. Keep seeing this, that's not good. Slight increase in activity, concerns over higher long-term rates. Kansas City, slight softening, loan diet in banking. None of these things are really good. Modest expansion, concerns over high interest rates and political environment. And San Francisco, stable activity, challenges with affordable housing. Analysis, there's a word. Consumer spending. The mixed consumer spending and decline in loan demand could be indicative of consumer caution, possibly due to inflation or political uncertainty. This is something to watch, especially with the holiday season coming up. Labor market, seizing the labor market. Less urgency in hiring can mean that the labor market is reaching equilibrium. However, the ongoing challenges, recruiting skilled tradespeople is a bottleneck. Price pressures. The inability of firms to pass on rising costs. He knows how to analyze something. The inability of firms to pass on rising costs to consumers could squeeze profit margins further, if affecting stock prices and investor sentiment. Given this, I'd say the report paints a picture of cautious optimism, but with several caveats that could impact the market sentiment. What are your thoughts? Blah, blah, blah. Okay, so there we are. And now let's see if we can give it a little read ourselves, just to get an idea. Nope. Most districts, little or no change in economic activity. Consumer spending was mixed. Retail auto, due to differences, prices, product, tourism activity continuing to improve. Some districts reported slight slowing in consumer travel. Banking contacts reported slight to modest declines in loan demand. Decline in loan demand, that's interesting. Consumer credit quality was generally described as stable or healthy, with delinquency rates still low, but slightly increasing. Real estate conditions were little changed on the inventory of homes for sale remained low. Manufacturing activity was mixed. Contacts across districts, improving outlook for the sector. The near-term outlook for the economy was generally described as stable or having slightly weaker growth. Expectations of firms for which the holiday shopping season is mixed, an important driver of demands were mixed. Expectations were holiday shopping, so people are a bit pessimistic there. Labor tightness continues to ease. Most districts, moderate increases. Firms are hiring less urgently. Several, and we heard that over and over again, right? So we're not going to see big wage increases probably at the moment. People are hiring, but they're not, they're not giving in to labor demands other than when the labor market is on strike. Several districts report improvements in hiring and retention of candidates. And those receiving offers have been less inclined to negotiate. However, most districts reported ongoing challenges recruiting skilled tradespeople. A few highlighted that older workers remaining in the labor force because they don't have enough money to live. Even staying a part-time. Wage growth remained modest and moderate in most districts. Contacts across many districts reported less pushback from candidates on wage offers. There were multiple reports to modify their compensation and mitigate labor costs, allowing remote work in lieu of higher wages. They're trading it off. Reducing sign-on bonuses or other wage enhancements, shifting compensation to more performance-based models, and passing on a greater share of health care to the employees. That's nice. Right? It doesn't tell you the full picture, right? Because I mean, somebody can give you if they give you a raise, but they don't give you health care, then you didn't really get a raise, did you? Prices continue to increase at a modest pace. Districts noted input cost increases have slowed or stabilized, but continue to rise for services. Increases fuel costs, wages, and contribute to growth in prices. Sales prices increase slower than input prices as businesses. So there's margin squeezes. That's what we're talking about. That's definitely a theme here. Firms struggle to maintain overall firms success. Highlights by Federal Reserve District. Okay, and then we're not going to go over district by district. So that's it. That's the report. These reports used to be much more extensive, and they cut them down drastically. Yeah, we probably got more out of our AIs as far as like what's going on than we did out of the actual reading of the book. But as I expected, though, Warren has the best analysis. He's really, he's really on top of stuff. That's a good report. It's incredible. I mean, this AI stuff is really amazing. So what else are we doing? Oh yeah, reviewing portfolios. That's right. Let's talk about that. Well, let's see how's the market doing after the beige book. That's a good question. Nope, stuttering along. Didn't improve the market's outlook because margin squeezes. How are you going to improve on that? So now we're going to go back. All right. So look, not that. Here's our portfolio reviews. I'm going to make this webinar very worthwhile, okay? Because I'm going to tell you how to make 200% in the next 2 years. All right, so this is our this is me talking about here's the money talk portfolio. That's up 300% in 2018. So this is going to be 5 years. No. Oh, no, that's not. No, we didn't. We started the money talk portfolio later than that. So it's 4 years basically. So 300% in 4 years is much better than we expected. The $700 a month portfolio is up 40% in 1 year. That's pretty damn good. Butterfly portfolio chugging along, and it's up 7.6%, and that's been 5 months. And the butterfly portfolio, by its nature, is not meant to make a lot of money quickly, but it accumulates. It like snowballs over time in an incredible way. Now it's the income portfolio. We started with 150,000 basically 5 months ago. We now have 183, so we're up 22%. And And it doesn't seem like much. It's 4% a month. I mean, 4% a month is what, you know, when you make that, you're going to make some really good money. And how do we do it? Well, here I go into deep detail. So I think it's very important to understand this. We're still relatively early in our cycle, but we have set up an amazing collection of trades. So we have CIM, which is short puts, so they've got that upside potential. We have BurgerFi, which I think can make 89% from where it is now. It's this little burger company here. It's like a penny stock practically. BXMT is Blackstone Mortgage Trust, 40% gain projected here. Pfizer, we didn't project Pfizer as a gain because I pointed that out here. See, when a stock is in trouble, we don't use it to forecast profits. We're happy to get even. And so Pfizer is struggling. They just lowered guidance tremendously. And we're going to just wait and see. We're going to wait and see if they bounce back or if they find a good bottom, and then we'll probably start pushing harder on them. QILD, I thought this was very interesting because QILD is an ETF that invests in the NASDAQ 100 and then just sells covered calls against it, which obviously we like that strategy, right? To sell covered calls constantly. They pay, but the problem is, as an ETF, though, they pay out the covered calls as a dividend. So but what that does is it makes them a good channel stock because they're never going to really gain much because they're paying out their money like a REIT. They keep paying out all the money to take in as a dividend. And they're capped because when the stocks take off, they get called away because they're selling short-term calls. We don't like selling short-term calls, but we took them and we made our own play on it, and that play has 32% left to gain. It's doing very well, so we're happy about that. It's just an experiment to see how it performs out, really, more than anything else. Then we got Barclays Bank. Barclays Bank can make 1,036% if we hit our goal. And that's pretty funny. We only need to get to 10. So, you know, we want Barclays to get back to 10. If they get back to 10, we're going to make 1,000% in January 2025. So just over a year and a quarter, and we can make that. That's why this portfolio is great, though. We have these incredible risk-reward trades. BeyondTex, $75,000 potential, but $27,000 of it is 8 more sales of short calls. So we're gonna, you know, the position is $17,000. If we hit our goal, we get $45,000 from being at 130. 130. See, 130 is right here. It's not like we're aiming for this. We're not shooting for the stars here, right? We just want to get back to 130. So we're betting that there's something in the company besides COVID, because the COVID thing is running down. And we're saying, well, you know, here's our biotech company. They've created one successful vaccine. Will they create another? We're betting they will. But meanwhile, the options are at such a premium that we can make 27,000 against our 17,000 just selling more short calls. So obviously we're going to do that. That means we're going to make, you know, this is up 27,000. So that means we're going to make $27,000. Even if we lose the original investment, we could be up $10,000, which is a nice percentage of 17, even if this thing doesn't do well at all. But if it does even a tiny bit well, if it just gets up to like 120, 100, 110, we're going to make a freaking fortune. Crocs is shoes. And again, this one, 2,364% is in this trade. So again, we really like it. We do need Crocs to go quite a bit higher. I think 110 is our target here. Yep, 110. I said you can't tell me. Yeah, so I said you can't tell me 110 is unrealistic for 2026. 110 right here. That's what we're looking to get back to. And obviously, it's not about the chart. I'm just pointing on the chart, but I mean it's about the valuations and such. Energy Transfer. This thing is insane. This is the best interest-paying stock, dividend-paying stock of all. They're just, I mean, it's natural gas pipelines. America is the biggest natural gas exporter in the world. That means we produce natural gas, put it in pipelines, and ship it overseas. And the exporting amount, what we're providing and what we're producing, is on a track to triple in the next 5 years. So how can this be a bad bet? It's like mindless to say this thing is going to go up, and we picked this trade where we make 32% in just 9 months. Intel, obviously, you guys know I've been banging the table on Intel forever. It's I don't want to say too late, but we're still going to make 342% from where it is now. But you missed the juicy part where we came in over here. We were like dying. Intel was the runner-up in November. It was the runner-up for our stock of the year. So in October, when I'm running down my stocks, and it is now October, that's what I have to do after starting now, between now and Thanksgiving, I have to start running my finalists. Not the finalists. I start running 100, 200 different stocks and looking at every single one to figure out which one's going to be the trade of the year. We're up to that time of year now, so that's my job for the next month. Coca-Cola. I mean, come on. 254% upside potential. And another one, no brainer. If it was trade of the year time, this would be one of my top 5. I mean, come on. This is ridiculous. Macy's also, again, another one. I'm like, come on, 86% upside potential. We haven't even covered it yet. NLY is the same basic company as CIM. It's not the same, it's different, 2 different companies, same management. So just another REIT run by the same management team. I think this is stupidly low, and it's 50% upside from here. SoFi has a potential for $20,000, and I think, it's net 800. So it's it's a ridiculous percentage. But I said basically, you have to. We moved a lot of stuff around, so we're just making a guess of about 20,000 upside potential for this thing. I love this trade, even though they're down 47 cents today. Totally great. SunPower, this is insane. I mean, they're treating them like this is our stock of the decade, and we cashed it out. We've cashed it out twice already in this decade, but now it's like, are you kidding me? I can take this for 572. So this has 200% upside potential. It's ridiculous. AT&T 400% upside potential. And what are we looking for? Our target is 20. Our target is 20 in 2 years. But again, we don't just count on the targets. We are selling puts and calls and creating our own, plus there's a dividend too on top of that for AT&T. And Walgreens, I talk about it all the time. It gets cheaper and cheaper, but I mean, for God's sakes, Rite Aid just declared bankruptcy. That's like, one of their main competitors just closed shop. People have to buy their drugs. They're going to go to Walgreens or CVS. The people who are at Rite Aid are going to go to Walgreens or CVS to buy their drugs, or the supermarket. That's really what's been hurting. Walgreens and CVS have been hurt mostly in America by this thing of supermarkets being drugstores. That is not happening in Europe. But in the US, it's a problem for them because all the supermarkets want to have pharmacies. But anyway, so this portfolio is capable of making, if all goes well, which it won't, but conceptually, it's capable of making $333,000, which is 181% between now and January of 2026, 2 years. And it's only up 20% so far. So there's none of these positions really that you missed, because the long-term potential is outrageous. So I just strongly urge you, and I was very much in teaching mode when I wrote this, so I very, very strongly urge you to take a very hard look at this particular portfolio, the income portfolio, and consider it as something that you can, deploy some capital into. I just think the potential here is incredible. On Friday, where's Friday? I think I go back out here. Here you go. Friday. So on Friday, we reviewed the short-term portfolio. That's where our hedges are. What is this? Did I hit the wrong thing? Friday. What is this? Oh, I'm not signed in. If I do that, will it sign me in? No, it will not. All right. That won't sign me in either. Oh, sorry, Sam. We're not going to be able to show you Friday because it's members only. Anyway, Friday we reviewed the short-term portfolio. We were working our way out of the SQQ trade we have. We're getting a little more aggressive on the NASDAQ shorts because we're in earnings season, and if anything's going to collapse, it's likely to collapse now. Today, as I noted in the Morning Post, we already had a few bad bank reports. Oh, I can show you that. I can show you my source material. So, briefing.com. So this morning, look at this. UniFirst missed, guide down. US Bank Corp beat but guide down. Travelers, insurance. Now, I'm very surprised by this, but it just depends on the kind of insurance. That's why you have to be careful. You can't say all insurance companies are going to do well. But this is way disappointing. And they're Dow component too. State Street, huge bank, big miss, gigantic miss. Northern Trust, big miss. Procter & Gamble, guide down. Citizens First, miss. Anybody else guide down? Nope, not at the moment. I mean, these are, oh, Winnebago. See, we talked about liking Winnebago. I don't think we have them. And here's yesterday, and look at yesterday, JB Hunt, not good. That was trucking. We had a discussion about that in chat. Pinnacle Financial, tiny miss, but it's a miss. United Airlines, they were okay, but they guided down. And I don't even know who these people are. Anyway, so you got to look at that and say, how are we doing? And now what's going on? Well, tonight first. Let's look at tonight. Who's reporting next? There's a lot of people. Tesla, Netflix. Talked about these in the Morning Post also. Las Vegas Sands. Equifax is huge. Discover Financial is huge. And Discover, you got to watch what they say about the consumers, right? Are they getting more defaults? Are they having lower spending things? This is the kind of stuff you want to look at here. Columbia. So not really a lot of banks here, because so far the trend is the banks are disappointing. So if we see a lot of banks, we got to worry. Alaska, one of my favorite airlines, American Airlines, AT&T, hopefully we'll be able to show people they're not totally crap. Atlantic, now here we get into trouble though. See, tomorrow morning, lots of banks, and we don't want to see a lot of banks because they've been disappointing. Freeport, too many banks. I'm worried about tomorrow. Make sure you get those hedges. Philip Morris, we'll see what happens. Texas Capital, Truist is the one, that new bank. Union Pacific is, again, we want to get that transport information because we looked it over today. And then after the close tomorrow, we got more transportation. We got another bank, another bank, another bank. ISRG, I used to love, but they got so expensive. Yeah, so, well, more banks. Too many banks tomorrow. I certainly would not be bullish going into tomorrow. Is because we get these underperformers. They shouldn't be having any misses. Banks should be barely any misses at all. That's not what's happening. All right, so we got to take this stuff really seriously. Definitely check out Friday's article. Look at the hedges and how we're moving to a more aggressive hedging stance. You just got to be very careful out there. So that's it for now. Thanks everybody for coming. I appreciate it, and we'll do this again next week. All right, take care. Oh, no, I think we'll do this on Wednesday. I'm going to be. I think I'm on Bloomberg next week, but I don't think it's going to interfere with the webinar. All right, so probably almost certainly next week. All right, thanks, everybody. Have a good day.